This is the 401k Fridays podcast, and I'm your host, Rick Unser. Now here we go with this week's episode. With 2021 officially underway, it was great to have Dr. David Kelly, the Chief Global Strategist and head of the Global Market Insight Strategy team for JP Morgan Asset Management, join me back on the podcast. As always, he shares some incredible insights, including what it will take inflation to get moving in this current low interest rate environment, how policies from the new Biden administration could impact the markets, and how with the current equity valuations and low interest rates, how that could spurn some new thinking about diversification, especially in workplace retirement plans. Great stuff as usual, and always appreciate getting some time with Dr. Kelly. Before we get started, if you've been enjoying the podcast, please take a minute and share with a friend, colleague, or networking group that you're part of. Best way to do that is just encourage people to go to their favorite podcast app and search 401k Fridays. Sometimes you need the little parentheses around the K, or just send them to 401kfridays.com, and they can find a lot of information about current and past episodes very easily on the website. The more listeners we have, and as the podcast continues to grow, the easier it is for me to get guests like Dr. Kelly to join us and share their insights, which hopefully helps you get a better understanding of what's going on in the world of 401k plans. That's it for now. Enjoy my conversation with Dr. Kelly. Well, Dr. Kelly, welcome back to the podcast. Excited to have you here. And really, as we kick off 2021, I can't wait to hear what you have to say about what's going on in the financial markets. So thanks for being here.
Very glad to be here.
So I guess if we're using the stock market as our barometer, we've recovered from the pandemic and we're in better shape than ever. Is that an accurate read of sort of where we are right now?
No, I don't think so. I mean, the problem is that in the long run, the stock market is determined by economic fundamentals. But in the short run, very often the stock market and the economy are in different sleep cycles. And I think certainly 2020 was a year in which the U.S. economy was going through a very traumatic experience. We all were going through a traumatic experience, but the stock market did very well. I think 2021 will be it'll be the year of the vaccine. I think things will improve a lot as the year goes on. But I think because of valuations, things may well be more challenging for markets. So in the short run, I just don't think the market reflects accurately what's going on in the economy or what people are experiencing in their own lives.
Yeah, and I think as well, and I guess I've been around long enough to remember this, there's some scary similarities to where we were sort of in the technology and telecommunications bubble or the dot-com bubble, however you want to phrase it. Am I imagining things there, or are there some parallels?
I think there are some parallels in terms of momentum investing and valuations. I remember in the late 1990s, people who spent too much time looking at valuations were regarded as being old-fashioned. And so long as you could put a .com at the end of something or claim that it had enough views on the internet, it would go up in price. And I think when you look particularly at mega cap growth stocks in the United States right now, you can see a lot of valuations which really don't make sense based on valuations, but they've been doing well and people are just piling into them because they've been doing well. So to that extent, there's a lot of similarity.
Another thing you mentioned, and I just didn't want to let this go too far, and this was actually kind of a theme of the last episode that we released, was based on how the country is doing, how individuals are doing, in the pandemic, or kind of as I guess maybe we're emerging from the pandemic. What's your sense there? I mean, again, I think if you look at the stock market, it says, hey, everybody's doing great, but I don't think that's the real story.
No, it's not. But I mean, the stock market can be pretty cold in terms of its reflection of what's going on in society. Obviously, a lot of people are experiencing personal pain. There's been, sadly, over 400,000 people have died from this. We've also got the economic fallout, and a lot of businesses have gone to the wall because of it. So there is a lot of pain. But what the stock market does, and what it should do, is reflect the long-term value that investors see in the companies that dominate the stock market. And one of the things we know about the U.S. stock market is the biggest companies in the stock market are very often technology firms, maybe financial firms, healthcare firms, consumer staples firms, and all these businesses have actually done fine during the pandemic. They can operate even in a pandemic environment. So a lot of the stock market, if you think about the earnings earned by companies in the stock market, they look pretty good, and the prospects for those earnings look very good. And I think that has helped move the market up, even though there is a lot of pain in the economy itself and in American families. But perhaps I don't want the stock market to reflect what's going on in the economy and the pandemic, because if it did, then everything would be down. At least one thing is doing okay in this otherwise very difficult environment.
I guess on that note, what signs point to caution moving forward in the equity markets? I mean, are there some obvious ones that you kind of have your eyes on?
Yes, well, there are two things. One is valuations, which are a very good measure of future returns over a long period of time. So if if things are overvalued or undervalued, it's pretty hard to say what the market's going to do over the next 1 year. But if you take it out to 5 years or 10 years, if you get into the market when it's cheap or into things that are cheap, they will generally do well over a 5 to 10 year period. If you get in when they're expensive, they'll do poorly. So one of the issues is valuations are just very high after years of great performance in U.S. equities. The other thing that I worry about a bit is we've sort of lost all fiscal discipline here. There is a pandemic. These are extraordinary times. But if we push too much money into the economy from the federal government, we do run the risk of sparking higher inflation. And if higher inflation means higher interest rates, that could obviously directly hurt bond investors, but it could also make it very hard to justify some of the valuations on particularly large cap growth companies, where the valuation models should be very sensitive to interest rates. And when interest rates go up, the value of all their future cash flows in current terms goes down. So I think I worry about valuations and I worry about inflation.
Yeah, and I guess just simplistically, as you kind of talk through that, and as I'm trying to react to that in my head, I think that's something I've seen and heard over the last, let's call it, year or so, with interest rates at 1% on a 10-year treasury, roughly 1%. The stock market doesn't look too bad. I guess how impactful is that in sort of driving these valuations to the levels they are today?
Well, it does sort of set up what's called the sort of TINA market. There is no alternative. I think one of the things that's helping the stock market clearly is that money that otherwise would have gone into bonds just has a very hard time finding a home there, given how low those rates are. But of course, these very low long-term interest rates, although they've been low for a while, it's sort of a disequilibrium position. I mean, it's a position that shouldn't be sustained in the long run. Once the pandemic's over, once the Federal Reserve moves back to a more normal stance of monetary policy, particularly if you've got a lot of fiscal stimulus, a lot of ways of helping out poor and middle-income households, I do expect that interest rates will go back up. And so stocks are a long-term investment. And I think investors should be careful about valuing stocks just on current interest rates. I think you also have to think about future interest rates. And I think future interest rates will be higher than they are today.
So let's pull on that string for a second. As we sit here today, the Biden administration is taking the controls. Obviously, a familiar face, Janet Yellen, is kind of coming back into the administration and has already made some strong comments. What's your sense on how the incoming Biden administration and maybe some of Yellen's policies impact things you just talked about, interest rates, inflation, things of that nature?
Well, I think one very important reality in the political spectrum right now is what happened with the Georgia Senate elections, because when the Democrats won those two seats, that does give them 50 seats in the Senate, and with Vice President Harris's tie-breaking vote, that gives them a majority. And I think that's important for two reasons. It's important first because the administration now can put on the floor whatever it wants to put on the floor. So, very often in the past, we've mostly had divided government over the years, and one of the frustrations for presidents has been that they could never get the Senate to give a hearing to whatever it was that they wanted to propose. So, whatever Joe Biden proposes legislation, it's at least going to get a hearing. That's the first thing. But also, I think there is a sense of urgency among the Democrats that they want to do something about the pandemic as quickly as possible, because we're all suffering from it. And they want to make sure that they build a bridge to get the economy back to good health as quickly as possible. And they have, so there's a lot of will to fix things, but there's also a way, because I think one of the things that President Biden has outlined is that his pretty much his first legislative priority is passing a rescue package, which he has outlined with a price tag of $1.9 trillion. And there's a lot of good stuff in there. I think it will help state and local governments. It will help workers who've been laid off until they can get their jobs back. It will speed vaccines to people and hopefully end the pandemic with a slightly lower death toll as soon as possible. But it also puts a lot of money into this economy. And I think what that's going to do is it's going to result in a really booming economy by the end of 2021, when we can all get back to normal. I think, in the fourth quarter of 2021, it's going to be pretty hard to find a table at a restaurant, to find a seat on an airline, or to find a room at a hotel. And so it's going to be a very boomy economy. I think that does mean higher interest rates. It means, of course, also, I think, better corporate profits. But I think for most assets, the increase in interest rates will probably be more important than somewhat higher corporate profits.
I know you have some great stuff in your Guide to the Markets report, which you publish on a quarterly basis. I guess to put maybe that in perspective, if we do see interest rates move from these abnormally low levels, 50 basis points or 100 basis points, what type of, I guess, reaction would you expect, or might you see on the equity side of the markets?
Well, you can always get a significant decline in equity markets. I mean, in recent years, equity markets have done very well, but corrections of a 20% decline are not unusual at all, and frankly, we seem to be pretty much overdue for one of those. So I think that is quite possible. And it's very hard to time this. We always tell people, don't try and time markets, because you really don't know when markets are going to get nervous. But I think as uncertainty diminishes, and I think that's one of the big things that's going to happen in 2021, the political question marks are gone, at least for the next few years. The pandemic, once it turns a corner, once we've got these vaccines getting distributed more widely, it'll be easier to see an end to that. And I think as that uncertainty clears, people are going to think much more carefully about what they own. Now, if you do get higher long-term interest rates, first of all, that makes bonds more attractive. But it also mathematically means that the value of cash flows, years ahead, is going to be less, and I think that does make stocks look more expensive. Because after all, a stock is like the longest term, long-term bond you've got. It's a perpetuity. It doesn't mature at all. And so when interest rates rise, those growth stocks, those where we're depending so much on future cash flows, they should get dinged. And then the other thing that has to be said is big deficit spending today must mean higher taxes at some stage in the future. And so I think at some stage markets are going to look beyond and to take for granted the recovery in the economy, and then get a little bit more nervous about when the bill is coming, and whether that's going to be levied on investors in the form of higher capital gains taxes, higher taxes on dividends, whether it's going to be levied on corporations in terms of higher corporate income taxes, or both. So I think there will be things to be nervous about, even as I think the economy will do much better as this year goes on.
I guess one more related question on that end about inflation. I think over the last several years, one of the concerns by a lot of folks in the market, including the Fed, has been we just don't have enough inflation. And I think as we sit here today, as you've talked about all this money that's likely coming into the economy and things of that nature, if we get to higher inflation, I guess how does that work? At what point in time do you think there gets to be too much inflation, or do we get a rate of inflation which maybe starts to put some of these things in motion that you've talked about already?
Well, I think the first thing is I have always been a little bit puzzled about why the central bank seems so worried about low inflation. I haven't seen much evidence that low inflation stops the economy from operating. The only thing that low inflation does from a Federal Reserve perspective is it means that low interest rates are less meaningful in trying to stimulate the economy. But since I don't think that cutting interest rates really stimulates the economy anyway, I don't lose any sleep over the Fed not having much power to do that. But we have had low inflation, and I think there are a number of reasons for that. The biggest long-term reason is really a technological reason. If you think about any market between a seller and a buyer, the key thing is information. Whoever has the information has the power. And it always used to be the case that sellers knew more about the thing they're selling than the buyers did. But if you think about it, one of the clear implications of the information revolution, which has been ongoing for decades now, is that it empowers buyers. If you're going to take out a new mortgage, you check it out online before you ever talk to a banker. If you're going to buy a new car, the same thing. If you want to buy an airline ticket, it's a click of a mouse to find the cheapest fare. And all of that power tends to push down prices. And that's been going on. It's turned more and more services and goods into commodities, and that's pushed down on inflation. But the other thing that's pushed down on inflation is growing inequality. There is a circular flow of income in the economy. You produce $100 worth of output, you generate $100 worth of income. And that income is supposed to go around the economy, come back and buy that output. That's how it all is supposed to work. But what's happened is over time, more and more of that income has fallen into the hands of people at the top 10% in terms of income. And they tend to save a much bigger share of their income. Sometimes, by some measures, about 30% of their income. And so what happens is a lot of money gets diverted from buying goods and services into buying assets. Now, what that's doing is it's actually leading to lower inflation or even sometimes falling prices in the price of goods and services, but it also has pushed up asset prices. And so I think that's really been the story of the last few decades, is one in which money gets diverted in the economy towards buying financial assets rather than goods and services. But a lot of that has to do with the fact that this is money that's being received by richer people. I'm not trying to make a normative judgment here. I don't really have a strong political view as to whether that's good or bad. But if a new administration tries to help poor and middle-income households by increasing taxes on upper-income individuals and pushes that money their way, or if they simply give tax cuts to those poor and middle-income households, they will tend to spend more money. They don't tend to save the money, they tend to spend the money. That tends to push up demand, that tends to push up inflation. So I think that we have to be careful and recognize that the very growth in inequality that we all want to do something about, that growth in inequality is probably responsible for a lot of the lack of inflation in recent years. And if we turn a corner and try and make our society more equal, however laudable that might be in some ways, it could also spark higher inflation that we've really avoided since the 1970s.
No, really well said, and a great viewpoint there. That's one I've not heard before. I think this is related to some of the stuff you just talked about in inflation, which is wage growth. And I think that's been something that a lot of folks in the economy have been frustrated with, is why aren't we seeing real wages growing at a faster pace? And I've got my own thoughts and opinions on that, but I certainly would love to hear yours.
Yeah, so I think there are a few things here also. One is we've seen decades in which the trade unions have lost power in the economy. So this used to be a very manufacturing-dominated economy back in the 1950s and 1960s. It was all about manufacturing. Manufacturing was unionized, and that helped push up wages. And that has gone away over the years. And so you've got fewer workers who are using collective bargaining. That does tend to undermine worker power. So that's one thing. I think a second thing is, generally speaking, unemployment benefits in the United States are pretty low across most states. And so it's in terms of what will somebody work for? Well, they'll work for, so long as you pay them more than they would get for not working, they'll accept it. And I think that has tended to hold down wages. I think a third thing that's helped hold down wages is competition from foreign workers, both in terms of international trade, which I think has helped push down manufacturing wages, and even illegal immigrants in the United States, where in some ways the illegal immigrant gets exploited by getting paid low wages, but it also really hurts wages at the bottom. So I think that has also contributed to this low wage growth. And then, of course, it's years since we've seen an increase in the federal minimum wage. While some states have increased minimum wages, many states have not, or don't even have a minimum wage, and that also, I think, has helped hold down wages. So there are a lot of long-term forces which are eroding the wages of, particularly people, lower wage workers. And one way of combating that is get the economy to be really, really, really hot, which I think is the way Janet Yellen looks at it and Jay Powell looks at it. If you get the unemployment rate down to 3.5%, maybe you'll get that higher wage growth. And while I think that is technically true that if you could just get to there. The problem is that by the time you have pushed up the wages of the least promising worker in the American economy, by getting a really, really tight labor market going, you probably also pushed up asset prices with that much stimulus, and I think that does set up the problems for the economy down the road. So it's tricky, and I think it's a multifaceted problem, but I think it needs a multifaceted solution. It can't just be solved by just trying to stoke this economy to a sort of white-hot heat of economic expansion. I don't think that's the right way to try to fix this problem.
Yeah. And if you're sitting in a boardroom talking to a company that has a 401k plan, a 403b plan, and they're sort of looking at their retirement plan and they're saying, okay, my plan balance is at an all-time high. My personal participant balance is at an all-time high, and I'm feeling pretty good about things right now. I guess pulling on some of the strings, or maybe if you have any additional thoughts that you would share, what would you kind of encourage them to think about as it relates to their investment menu, or how this all kind of translates to whether they should stay the course or maybe kind of think a little differently about what they're doing in that retirement plan investment lineup that they have?
Well, I think the first thing to say is, yes, those plan balances look very high, and indeed we've seen an enormous growth in the value of financial assets in recent years. But the yield on those assets has fallen to very low levels. So to the extent that people are going to use these assets to fund a retirement, if they're going to try and generate a yield out of them, and that's the only way they're going to try and spend this money, then they're going to need a bigger pile than they ever thought they needed before, because those yields are so low. So I think we shouldn't be complacent about this. We should recognize that ultimately these assets have to fund a retirement. And you can annuitize it, and that's certainly one way you could go. But there are challenges even with a big accumulation if the available yields, dividend yields, coupon yields on these the stocks and bonds embedded in these funds have fallen to very low levels. The other thing I would say is we need to be realistic about relative valuations. People have a habit of piling onto whatever's done well recently. U.S. stocks have done well recently in the last few years, but they are more expensive than international stocks. Growth stocks have done much better than value stocks recently, but again, they are significantly more expensive based on history. And I think we can never tell investors often enough that it's very important to look at valuations and not just what's done well recently, and to spread that money around. So I think part of it is you want to make sure people are not underweight value stocks, underweight international stocks. You want to make sure that they can take advantage of things that are actually cheap in this environment, rather than just piling into whatever has done well recently. And then the second thing I would say is remind people that there is a value in diversification, not just hedging. To me, the difference between hedging and diversification is hedging is when you know what the risk is. Diversification is when you don't have a clue what the risk is. So if I thought the only problem that we're going to face is inflation, then maybe I'd say, well, okay, buy some gold, buy some real estate, buy some infrastructure. That'll probably protect you. But if the truth is, I don't know what the next thing is going to get you is, then you really need to be very spread around. And if you look back over the last 25 years, how many of us would have predicted 9/11?
Yeah.
How many of us would have predicted that a small crisis in subprime mortgages was going to end up blowing up the entire global financial system? How many of us would have thought that the economy would see its worst recession since the Great Depression because of a pandemic? The reason you diversify is not because of what you expect, it's because of the stuff you don't expect that ends up biting you. So I'd say look at valuations, encourage people not just to pile into what's done well recently, but also maintain that diversification, because we really don't know where the next risk is coming from.
And that's so well said. And I think one of the challenges for a lot of employers, especially as they're looking at their retirement plans and considering their fiduciary responsibility to the plan participants, is I think a lot of people, let's just pick on target date funds for a second, because I think that's a very interesting and unique asset class that has really taken over most retirement plans, and in some cases is 90% or more of the assets in some plans and some very large plans. I think the challenge for a lot of employers is they're saying, well, I'm looking at my target date fund and, maybe it's done okay, but I look at this other target date fund and that's done great. How come our target date fund didn't do that well, or why aren't we using that one? And I feel like what is going to be a really interesting conversation for a lot of employers is, to the extent that they peel the layers of the onion back a little bit, I think a lot of people, if they do that, are going to find that the best performing investments in the target date world have been highly concentrated in growth, highly concentrated in large cap, and highly concentrated in U.S. equity. And I think there's a real risk out there. So what's your sense on, or is there anything maybe different or new you would encourage somebody to think about to kind of give them the courage or the conviction to say, all right, if you understand your strategy and you understand what's going on, stay the course versus, go to the hot hand?
Well, yes. I think we have a chart in our guide to the markets, which we use all the time. And I know many other companies have a similar chart, which shows the relative performance of different asset classes in every year going back the last 15 years, and they're all color coded. And you think you'd see a pattern, but you don't. It's just a big old mess of different squares because there isn't a pattern.
That is one of the most frustrating things. You can't find the pattern; it just doesn't exist.
But you can't find a pattern. But what you can find is that if you pick something that has done really well in a given year, it is an absolute coin toss as to whether it'll do well the next year or not. You really can't use past performance to predict future returns. What you can say is that in the long run, though, valuations do have a significant impact on future returns. And so I think it's very important to take a look at those relative valuations. And if as a long-term, as a short-term investor, maybe I think momentum is going to work, and I'll just stick with whatever's been doing well. In the long run, though, I want to buy the stuff that is, got reasonable prices. I don't want to buy the stuff that's very expensive, and so I think people just need to do that. And the other thing I'd say is, when it comes to investing, it's difficult because everybody's, of course, thinking about the same things. So how do you beat the crowd? And I think the way you beat the crowd is by taking advantage of what I'd call the prejudices of the crowd. Prejudice is I guess it would be defined as a strong feeling which is based on the evidence. It's just how people feel. And people, for example, feel terrible about European stocks. They don't want to touch them, and they feel very good about U.S. growth stocks. But as I said, a prejudice is unfounded on the facts, and if it's not nourished by some fresh evidence, will eventually wither. So at some stage, the gap that we see between large cap U.S. growth companies and, say, European financial companies, that gap is likely to close. And so it's important to just think about what is truly justified. Not, I understand certain companies do more interesting things than other companies, but truly what difference in valuations is justified by the evidence and what is just people chasing after whatever's done well recently. And if you see something that's been moved by the crowd much more than by logic, you should really try and bet the other way.
No, well said. And that's a great transition to kind of where I wanted to take you next, which was just looking across the pond. I know we've spent a lot of time talking about what's going on here in the U.S., but how does either some of the trends here in the U.S. impact what's going on across the pond, or ponds, plural, or vice versa? How are those trends outside the U.S. potentially going to influence what's happening here in the U.S. markets?
It's really interesting you asked me about across the pond, because, of course, growing up in Ireland and even living in America for a long time, across the pond was always the Atlantic Ocean. And we always thought about international as being some mixture of U.S. and Europe, and maybe a sprinkling of emerging markets. But it was really all about the United States and Europe. And you're quite right. It's about across the ponds, not the pond, because we've been watching particularly China for many years grow bigger and bigger and bigger. And even if it's growing bigger at a slightly slower rate, it's still growing bigger much faster than we are. We estimate that by 2027, 6 years from now, China will, for the first time in 130 years, be the biggest economy in the world again, and we will fall into second place. They've got the second biggest equity market in the world, the second biggest bond market in the world. They are growing fast. Obviously we have a lot of problems with many things in terms of the way the Chinese government runs their country. But we can't deny their growth. We shouldn't ignore them. And so when you think about investing, I think, outside the United States, I think part of the story is, yes, I think there are opportunities in Europe. I think European stocks are cheap. They are very unloved. And there's some good opportunities. I think there'll be good opportunities as the pandemic ends. But we should also recognize that East Asia is also growing very strongly, and in fact is growing stronger than Europe and will continue to do so. And countries like China and, for that matter, Korea and Taiwan, I think they will continue to see strong growth. And I think it's important for investors to think about that in terms of investing opportunities also, both in fixed income and particularly in equities. So I think people do need to think about international, but they need to think about international in a truly global way. And it's not just a bet or a question mark about what happens in Europe.
And do you get the sense that people in the U.S. still have a home country bias when it comes to investing their dollars?
Absolutely. And I understand why, because people like to invest in what's familiar. But that's why you use trusted portfolio managers to invest both here and around the world. You need people who are going to be good stewards of your money and invest it wisely. But it doesn't make sense. I mean, the United States, remarkably, it represents about 56% of global stock market valuation. So even though we are 5% of the global population and maybe 20% of the global economy, we represent 56% of the global stock market. But I would be happy if Americans had just 56% of their equity exposure in the United States. But of course, they've got much more. Many people have got 70%, 80%, 90% of their equity money in the U.S. stock market. And I think that's a mistake. There are a lot of opportunities all over the world. They're perfectly accessible through good portfolio managers, and it makes, if anything, it makes sense to be overweight the rest of the world. I mean, if you think about it, you've got to think about it in terms of all your assets. So, okay, you've got your portfolio, your 401k, for example, but you've also got your house, you've got your job. Your house is a U.S. house. Your job is a U.S. job. Are you sure you want to put all your investment eggs in that same basket? Or do you think that a good way of actually diversifying your overall financial exposure is to have more money invested overseas? So I think for the most part, Americans are underinvested in global equities. I think there's a lot of opportunity there. I think it's the right thing to do, both from a long-term return perspective, but also from a risk perspective.
I'm going to get out of my depth here for a minute and plead ignorance. I've heard a lot of people starting to talk about the dollar, and I've got to be honest, I struggle to convey what the significance of that means to, various investments. So what is, I guess, the current state of the dollar, and what are your thoughts on where do we go from here, and what could that mean for investors in the U.S. and 401k plans?
Yeah, well, the first thing is I think the dollar has been too high for too long. We've had a very expensive U.S. dollar. It's for anybody who's been traveling overseas, it's been pretty cheap to buy stuff overseas because the dollar has been so high. The problem is that gives us a big trade deficit. We buy everybody else's stuff because it's cheap, and they don't want to buy our stuff because it's expensive. But why does the dollar matter from an investment perspective? It's actually one of the simplest relationships in finance. If you look at it sort of from this perspective, if you own international stocks, bonds, or whatever, if you own international financial assets, if the dollar falls 10% overnight, then your international holdings are worth 10% more in the morning, measured in dollars, and that's what you measure in. So what we saw, particularly at the end of the last decade, is that U.S. stocks were beating international stocks year after year after year. But a big reason for that was a rising dollar. And now we've seen the dollar in recent months begin to come down again. And the question is, will it continue to come down? Because if it does, that falling dollar will actually amplify the return of international investments. If the euros are worth more, if the yen is worth more, then that will enhance the return that people get on those international investments. So I think it's very important. I also think it probably will come down over time because of our trade deficit, although I will say there are a lot of forces that affect the dollar. Interest rates affect the dollar, relative economic growth affects the dollar, U.S. trade policy affects the dollar. So there are lots of things that affect it, but overall we think that in the long run the dollar should come down, and if it does, it will tend to amplify the return on international investments.
Got it. And I guess just kind of maybe somewhat completing our travel around the financial markets, you've hit a little bit on interest rates and inflation, but I guess if you sit there and look at what's going on in the fixed income or in the bond market, it seems like a pretty interesting time to be a fixed income investor. What do you see over the next several years, and what does that mean for folks that are kind of making decisions about 401k plans in terms of how they should maybe look at or think about what options they're providing in the fixed income space?
Well, it's tricky because the problem is it's kind of like if you ever ask directions in Dublin, somebody will surely tell you, well, I wouldn't start from here. and I wouldn't start from here in terms of investing in fixed income. The interest rates are just too low. The interest rates are low across the board in fixed income markets, whether it is treasuries or corporate bonds, high yield bonds, municipal bonds, emerging market debt. I mean, of those, I think emerging market debt is probably the best value here. So I think it's okay to have perhaps some exposure to emerging market debt if you've got a big plan and that's something that you want to offer people. I think you have to give people that fixed income exposure, but I think it's got to be out there, but you should warn people that if you start from these rates, you can run some simulations. It's pretty straightforward. If, for example, a 10-year Treasury bond right now, it's got a yield of 1.1%. If a year from now that is at 2.1%, your total return is going to be about -7% for the year. And that it's very easy to get that kind of result. So with interest rates this low, I think long-term investors should be underweight fixed income. And I think they should, they need to have a very diversified portfolio. So that means putting other things into the portfolio, which will perhaps stabilize it, some alternative investments, dividend-paying stocks, some international developed country stocks. I think are ways to go. Obviously, real estate, commodities are other things you can put in there. But I would generally try to be underweight fixed income in a portfolio right now because you're just not getting paid for taking a lot of the risks that exist in fixed income.
And that's such a good point. And I feel like in a lot of 401k plans, retirement plans here in the U.S., I think to a certain degree that the trend in the market has been towards a little bit more simplification in terms of the number of investments that people are providing. And I think also what we've seen is just with the success of passive investing over the last several years, there's been just a more of a move to, again, not only condensing the number of options and the number of asset classes, but also kind of moving from active to passive in a lot of those asset classes. I don't know, maybe I'm setting up a little bit here, but my personal opinion is I look out over the next decade, and you could probably, you will be able to enumerate this a lot better than I ever could. I think that what obviously did well over the last decade, probably that formula doesn't work, as well, let's just say, in the new decade. So if I'm sitting in that boardroom with that employer saying, hey, I get it. I know you love your S&P 500 index, but here's the argument for more diversification, not just growth and value or large cap and small cap, but here's the argument for increasing the amount of diversification you have in your 401k plan. I guess, how does that go, or what does that look like?
Well, I think that's absolutely right. I mean, one of the things that the sort of pandemic economy has done is it made everybody so confused and uncertain about what was going to happen that a lot of people just threw up their hands at active investing and piled into what I'd call momentum investing and into passive investing. So they'd either, they'd put money into, invest in large cap growth stocks, which had done well, so they double up that bet, or they'd simply go passive. And the problem about passive is that an index, an S&P 500 index fund, by definition, is most overweight those things which are most overpriced. I mean, it is capitalized weighted. So if, for example, the top 10 stocks in the S&P 500 are right now selling, or at the end of last year, we're selling at 77% above their 25-year average PE. Whereas all the other stocks, the other 490-odd stocks in the S&P 500, were selling at 27% above their 25-year price earnings ratio. So the top stocks were much more expensive than the rest of the stocks, but the problem is all these indices are overweight the top stocks. And you can see this within the stock market. There's far more. There's the valuations. The dispersion of valuations has also grown because people have been piling into whatever is most exciting. And when I see that, when I see a lot of people sort of closing their eyes and investing based on momentum or on just pure indexing, you realize that people who sit down with pen and paper and burn the midnight oil trying to figure out what things are valued or what they're actually worth, those people have less employment and markets get more and more distorted. But the thing is, because of that, if distorted markets are really what active managers look for. All they have to do is figure out what are the babies and what are the bathwaters, and then invest and wait until everybody else figures it out. And so what I think there's sort of a tide in the affairs of financial markets, so to speak. And when you have years in which momentum investing and indexing is doing very well, it creates a lot of distortions in markets. It causes things to be overvalued vastly and undervalued vastly. And then when the pendulum swings back, those people who've invested in those things which are cheapest do best, and those who have got their money invested in those things which are most expensive do worse. And so I think looking forward as we get past the pandemic economy, as we return to a more normal, hopefully quiet few years after a very, very traumatic year in 2020, I do think this should be a good time for active managers and those who've invested actively to reap some reward from actually thinking about what things are valued as opposed to just closing their eyes and going with the indices or momentum investing.
And maybe a thought to kind of move us towards a close here. Obviously, the last decade was an amazing decade for returns in the equity market. I feel like you highlighted this a little bit in your guide to the markets, where based on where we are today, some of the 5-year expectations, I don't want to put words in your mouth, but I feel like some of the 10-year expectations are actually somewhat muted for equity markets. I think we're at a very interesting point. I think there's going to be a lot of things going on, but in the end, I guess, is if we look out to 2025, 2030, is there a chance that maybe we haven't made a ton of progress or a ton of forward movement, especially compared to the pace of forward movement we saw over the last decade?
I think that's right. I mean, I think that the future is not preordained, and there are things that could happen in terms of government policy, monetary policy, immigration policy, trade policy, investment ideas. There are things we could do to make the economy grow faster to help returns be better. So that's certainly true. But even more than the overall markets or what the overall markets are going to do, your future as an investor is by no means preordained. You can get much better returns than the average person, even in a difficult market. And I agree with you. The returns for the market overall don't look terribly promising starting from here. But average investors should be able to do much better than that because they can take advantage of the distortions in markets, invest in the stuff that is significantly cheaper, and make sure they're underweight the stuff that's significantly more expensive, and thereby do better than the markets overall. So I think that's part of the story. Is you don't wave the white flag and assume you're just going to get these miserable returns. There are things you can do about it. And then the other thing, though, is, if you've accumulated a lot of money, you've achieved all your retirement goals, fine, in terms of asset accumulation. But if you haven't, you need to be realistic. The market's not going to give you the same money over the next 10 years as it did over the last 10 years, and therefore you may need to save more of what you earn. You need to deliberately invest more of what you've saved, and I think you have to just remember to diversify what you've invested. And to continue to be diversified, because we don't know. We think that something will eventually shock markets. We don't know what direction that shock's going to come from. So you really do need to be diversified.
Well, you shared a ton of info. I guess last question, and then I'll let you run. What haven't we talked about, or what's something that you don't feel like is getting a lot of attention in the markets, or in some way, shape, or form that could become a bigger deal or a bigger trend, either positive or negative, in the in the coming years?
I would say taxes. I think that for years we've been running bigger and bigger budget deficits. We see a lot of attention being paid to stimulating the economy out of this problem, stimulating the economy out of that problem. But if it means that in each year we as a federal government are living beyond our means, if we're spending much more money than we're taking in taxes, it does mean in the future that taxes are going to have to be higher. And I do think that there's going to come a point in the next few years where the government is going to have to raise taxes just to try to control the growth in its deficit. And so I think it's important for people to, again, be modest in their expectations of what markets are going to give them, recognize that taxes may be a headwind in the future, recognize that government spending will probably not grow as fast in the future also. So it could be we've had this tremendous tailwind behind us as investors for many, many years. And I think it's important to recognize that tailwind and to recognize that we may face more of a headwind going forward. And that's why I think it's time for people to be modest in their expectations, disciplined in their saving and their investing, and really and active and thinking about what it is that they own, and make sure that they're not just piling into whatever is most overpriced but overloved in markets.
Very well said. I really appreciate all the thoughts you shared today. As usual, timely, helpful, and certainly gave me a lot to think about. So I hope all of our listeners got a lot from them as well. So thank you again for being here, and certainly we'll look forward to having you back sometime down the road.
I'd love to do that. Thank you.
And there you have it, Dr. David Kelly, Chief Global Strategist and Head of the Global Market Insight Strategy Team for JP Morgan Asset Management. Always good stuff. I would encourage you to download or review or subscribe to their Guide to the Markets. I do think that is one of the better quarterly summaries of what's going on in the markets to get an idea of trends and numbers and statistics. Very helpful. So I'll include a link here in the podcast notes. Also loved his comments on inflation and what it's going to take to get that moving, getting more money into the hands of workers who will actually spend it versus save it. And some really interesting thoughts about diversification again, just great stuff. And also hope his optimism about the fourth quarter, where it's going to be hard to get a concert ticket, a plane flight, a hotel room. Hope some version of that comes true. So again, really appreciate the time and really appreciate all of his great insights as usual. As a reminder, if you are not subscribed to the podcast, do take care of that today. You can just go to your favorite podcast app, search 401k Fridays, hit subscribe, and you will not miss any future episodes. That's it for now. Until next time, I hope you make your Friday a 401k Friday. And now for some disclosures. The content in this podcast is provided for educational and discussion purposes only. Investing involves risk, including a potential loss of investment. Lockton does not and cannot guarantee the future performance or specific level of performance, the success of any investment, or success of any strategy. Nothing contained herein may be construed as investment or legal advice.